George Soros and the silver moonshot. Martin North, John Adams, in the interest of people. Hello, John.
Hello, Martin. How are you going today?
Yeah, pretty good. Now, I'm guessing that people will hear George Soros and run for the hills.
Well, that potentially could be the case. Mr. Soros nowadays is highly unpopular because of some of his political activities, but there is a real economic lesson to be learnt from some of the activities, some of the investment activities that George Soros has done, and so I definitely think it's worthwhile to cover. Something that George Soros was involved in 1992 when he broke the Bank of England, and how does that actually apply to the silver market? So we did. So we know, Martin, that quite a few of our audience members are interested in gold and silver and cryptos, and obviously people know that I'm heavily invested in gold and silver, particularly silver, and I work for a bullion company. So I've been studying this silver market for quite a while, and in the last month we've seen a lot of chatter, both in the financial press, mainstream media, Twitter, as well as on Wall Street Bets, about a silver squeeze. And so it's actually a very important component about the financial system. And I think silver, as well as gold, are going to be a big story in 2021. And just to give, and it will be a big story because of the previous show that we did about accelerated stagflation. So anytime we've had stagflation, when we have stagflation or runaway inflation, typically there is a flight to gold and silver because they tend to appreciate as a currency falls, as inflation rises. We have started to see some of that. Some people think that that given the dynamics of the silver market and the macro picture, there's a commercial opportunity to be made, and there's an opportunity to harm the financial elite who are heavily on the other side of the silver bet. And so today is really to cover some old ground. So we did a couple of shows last year about silver, and we did the first show we did was the economic paradox that will change your life forever, and that was talking about a number of set of facts that didn't make any economic sense. And I said to people, if you can solve this out and you can understand its true dimensions, it will have a profound impact on your ideas about economics, but also the world in general. And we did it about early June. And then we did a show where we actually revealed the answer, and it was about silver. And we talked about how the silver market is manipulated heavily, the most manipulated market in the world. Now, some people across both Australia and the world reject that the market is manipulated, but one of the key facts to note is that there's only one good or service in Australia that is cheaper than its 1980 price, and that is silver. So we've seen a massive explosion of the money supply in 40 years, and everything's gone up in price, from cars to real estate to food to gold, except for one thing, and that is silver. And the question is, well, how is that even possible from a basic economic picture? There is a number of people across the world who have been sort of screaming about market manipulation. And we do know that there is some market manipulation, because JP Morgan last year was fined $920 million by the Department of Justice for spoofing, which is a form of manipulation. But there's, I think, much more to it. So and I should say, there's quite a few of our audience members who already own silver. I do think there's a lot of people who, as we go forward, will take a greater interest in this sort of market, as well as in the gold market. So the purpose of today's show is to cover an article that I wrote about last year on my website, George Soros and Silver Moonshot. And it's about taking a basic economic concept that I learned in the first year microeconomics at the University of Wollongong, and see how George Soros applied it in 1992, where he made a lot of money, and how I think it's relevant to the silver market. and then obviously, give a different perspective that I don't think anyone in the world has really sort of put together. Because as I constructed this argument last year, no one in the silver community or the gold community has ever sort of looked at the way I look at this particular market.
And I think it's worth saying, John, that whatever your position is vis-a-vis silver, right, there is a spotlight here which is relevant to the broader economy and the financial markets and how they operate and how they're manipulated more generally, right? I mean, my position with silver is very different to yours, but nevertheless, some of the insights that we're going to touch on are pretty scary if you apply it more generally too.
Indeed. So what I want to do first, Martin, is that, so I just want to put slide 1 up on the screen for our audience. So when we think about a basic market, so basic economic theory, we have demand and the law of demand, and we have supply, the law of supply. And when demand and supply meet, you have equilibrium, and you have an equilibrium price, and you have an equilibrium quantity. And that's what should happen in a free market. That's the most basic understanding of the market system. No matter which sort of economic textbook that you pick up, I mean, it is the core essence of what is economics. And obviously this was first written at length in the 18th century by Adam Smith when he talked about the wealth of nations. So that's what the basic market looks like. Now, if we go to slide 2, let's just put that on the screen. I've got it here in front of me. So we've got a situation where you can have market distortions. So governments can distort markets, and then you have corporations and central banks that they can distort markets, and then sometimes through financial fraud, markets can be distorted. Now, for first year microeconomics, you learn about something very basic called price ceilings and price floors. A price ceiling is where a price is not allowed to go above a certain point, and a price floor is where a price is not allowed to go below a certain point. Now, if a price floor, so let's just consider this thing. So if a price floor is above equilibrium, so basically the free market says the price of a commodity should be a certain price, but the price is actually above that price, and it's not allowed to go towards its natural market price. Well, what happens in the market? You have an excess of supply, and then you have some market distortions that happen in that sort of situation. Now, on the flip side, if you have a price ceiling below equilibrium, so basically the price is below what it should be, and for whatever reason the price can't go above a certain level, well, then you have another form of distortions. It's called excess demand. And basically, sometimes, for example, governments may, I think Richard Nixon in the 1970s had wage and price controls. Sometimes, for example, when you had hyperinflation in 2008 in Zimbabwe, Robert Mugabe used price controls to control the price of food. So we've seen, even in some of the commentary that you and I have done about the property market, I mean, one could say that the price of property vis-a-vis monetary policy, the price of property is basically, there's a price floor under the property market. So basically, the consequences of property falling to its real value is so significant to the economy that the central banks won't allow. So they basically, run these extraordinary economic stimulus policies to effectively cement a price floor under the property market. And that's something that you and I have talked about. So price ceilings and price floors, these are common tactics that are used by governments for public policy reasons, and they tend to end up in making things worse from an economic point of view, but also central banks and a whole bunch of corporate entities have been involved in rigging markets in one form or another. And when you hear about a market that's being rigged, typically you're talking about either a price floor or a price ceiling, and that creates problems in those markets. But it also creates opportunities. And in 1992, George Soros saw a massive opportunity using this basic concept, and that's how he broke the Bank of England. And I think there's a similar opportunity in the silver market. But before we talk about George Soros, Any comments from you, Martin?
Well, yes, just to say, of course, that what we're talking about here are large players with financial muscle, or governments or reserve banks or central banks with muscle, who are able to essentially manipulate the markets by buying or selling vast quantities or setting the price or whatever, or otherwise controlling the price, so that effectively free market conditions don't apply. And as soon as free market conditions don't apply, then whatever the price is not what the natural price is.
Correct. Now, one of the key points, Martin, is that when you have a distorted market, and then the market becomes free, well, what happens to the price?
Yeah.
The price goes in a very dramatic fashion towards whatever the equilibrium price is. So, for example, if we stopped this extraordinary, in terms of the economic stimulus that we're running at the moment, and the property market crashed, well, what would happen to? Well, sorry. What I should say is, if we had the extraordinary economic stimulus, so if that was to stop, what would happen to property? It would crash to its equilibrium price. So it's being held up by all the stimulus. If the stimulus stops, it will crash, and that's where our forecasts, some of our forecasts of Gen thesis, about a 40-50% crash in the market. I mean, this is on the basis that these distorted policies and this distorted price level will come to an end, and the market will go to its free market value, and the price of property is way below what it is currently in terms of the moment. Now,
sorry, John, it's worth saying, therefore, what we're actually saying is that when you're thinking about economics, right, supply demand, you've also got to be thinking then about the political and economic levers that regulators and governments and banks are likely to use to get to their own ends, which may well have nothing to do with price equilibrium.
Of course, yes. So absolutely. If any market is manipulated, there's a reason why they did it, and typically, if it's in their interest to continue the manipulation, they will try to perpetuate that until the situation becomes unbearable. So let me give an example. So in Zimbabwe, the cost of food was going through the roof because of hyperinflation. People couldn't afford it because the money was worthless. Robert Mugabe, as a political reason or a political factor, put in a price control and said, for example, the price of bread can't go above a certain price. Well, retail shops couldn't make any money because of the price control. So if they, for example, had to buy a loaf of bread at, say, 10 million Zimbabwean dollars, but they could only sell it at 2 million Zimbabwean dollars, well, they're not going to make a profit. And so what would happen from that was you just saw a whole bunch of supermarkets that had no food on the shelves because people weren't willing to buy, retailers were not willing to buy produce and sell it at a loss. So that was a consequence of the price control. And then once you had shelves in Zimbabwe that were empty, well, that created a new political problem. And as a result of that, they basically had to stop using the Zimbabwean dollar, start using American dollars. The price controls went away, and then retailers started putting food back on the shelves, and people were able to eat. So you're absolutely right that there are situations where there are a whole bunch of political and economic factors and interests involved in the manipulation, and when those conditions become so extreme, sometimes they'll walk away from that manipulation, or if it's still in their interest to perpetuate the manipulation, they'll continue to do that. Now,
yeah, and it's worth saying, just to build on that, John, that the longer it goes on, and the further from, if you like, the free market price the conditions are, the more difficult it is to perpetuate the mismatch.
Correct. Yeah, yes. So absolutely right. The longer it goes on, the greater the distortions. It's harder to continue it on. Now, obviously, what we just said before is that once these manipulations or these price controls stop, and the price goes towards equilibrium, if you are positioned correctly in that particular market, whatever that market is, people can make a lot of money. And obviously, some of our audience, for example, who think that property may crash, have sold their property and are renting, thinking that if property crashes, they can buy property at a cheaper price and they'll be able to make quite a bit of money rather than sort of holding on to the asset that they currently have. And so people have made all sorts of financial decisions, whether it's about property or shares or bonds or cash or bullion or cryptos, etc., based on their future expectations on in terms of where price is going to go. So in the article I wrote, I talked about a concept called asymmetric financial returns. And what that basically means is that when a price is distorted, for example, if the price is below equilibrium, the risk that the price will fall below its distorted level is relatively small relative to the price going up towards in terms of equilibrium. And then on the flip side, if a price is high, the risk of the price going even higher away from equilibrium, that is somewhat lower than the price falling. And so when you sort of find these opportunities, the way I think of this is that if you anticipate, for example, the price of something going up in a distorted market, well, obviously you've got this concept of financial risk. And to my mind, if the risk of the price falling, even though we know it's well below what it should be, the price of it falling is relatively small compared to the opportunity of the price rising, or vice versa. And so that's why I think it's not an even conversation between risk and reward. The reward is much higher than the risk because of its distortion and how far the market price is away from the natural equilibrium price. And that is the core concept that George Soros was able to achieve or discover in terms of the UK. So what happened in the UK? So in 1990, the British government of John Major signed up to a exchange rate mechanism called the ERM, the exchange rate mechanism, and basically there was a lot of volatility in these exchange rates. So this was obviously before the euro. So there was a lot of volatility between these exchange rates across the European continent, and that was creating it. That was making it difficult for in terms of the number of British businesses to have certainty about what the exchange rates would be. And obviously that volatility was also creating issues around inflation, etc. So they thought to themselves, well, if we fix the exchange rate against the German mark, then we can create some stability that will actually temper inflation, help promote economic growth, and give business certainty around trade. And so they entered this agreement, and for the first couple of years, that worked up until Soros found a way to break this manipulation. Because effectively, this exchange rate mechanism, it was fixing the exchange rate at a level which ended up being much higher than what the real value of the pound was. Now, when they constructed the ERM, they had a certain target in which the pound could deviate away from the mark, and basically they were doing a number of things to keep it within that range. And then in the first couple of years, it worked until a number of factors started to play out in 1992. But before I go into those factors, obviously you were in the UK during this period. Do you want to sort of provide your high-level thoughts about what you remember of the exchange rate mechanism under John Major?
Yeah, well, it was an astonishing time, John, insofar that, what you were being told and what was actually happening was quite different. And that the rationale behind it was also quite different. And I still remember they kept sort of jacking the rates, changing the rates, trying to adjust, and basically they failed and had to jump out of the ERM. And I think that was probably a most significant event, politically speaking, as well as economically speaking, that the UK really has never recovered from.
But yeah, that is exactly correct. Now, I've just got the figure in front of me. So when they fixed the pound to the Deutschmark, it was £1 for which was equivalent of 2.95 Deutschmarks.
Yep.
Now, and then they had a range where the pound could deviate up from about 2.78 Deutschmarks up to 3.13. Now, what started to happen in 1992 was inflation started to rise in Germany, and the Bundesbank started to raise interest rates. And because the interest rates in Germany were higher than in the UK, what that meant was that the pound was starting to fall. And it started to get very low in this trading range. Here's the thing. So in the 80s, under Thatcher, there was a massive housing bubble and a housing boom. And they didn't want to raise interest rates under John Major because of what that would mean to the housing market and to the banks. But they had this problem of the exchange rate. And they weren't willing to abandon the exchange rate mechanism. So they needed to continue the manipulation to continue so that they could keep up with this agreement they had with the Germans. Now, how do they try to do that? So there's a few things that that John Major tried to do. The first thing is that the British officials went to the German government and said, stop raising interest rates. And the Germans basically told them to go jump in the lake. So asking them politely in the European parlance, that didn't work. The second thing is that the British government actually took out a loan of £7.2 billion so they could actually have reserves to keep up this level. So if the value of the pound is falling, how do you keep it in this trading range? You've got to keep on buying pounds to keep up its value on the foreign exchange markets. So who was doing that? It was actually the Bank of England. And how do they finance those purchases? They borrowed the money. And that was £7.2 billion. So that worked to a certain extent. But then what we saw was that there were some comments from the German leadership to say that they were not going to step in and help the British. And that created some real concerns about, well, where is the pound going to go? So Soros, he looked at the situation and he realized that the real value of the pound was a lot lower than what this exchange rate mechanism trading range was. And he basically thought to himself, well, if the pound falls to its natural level, this is going to create an enormous opportunity to make a lot of money. So he placed 3 bets about the pound collapsing. Now, we've just got the slide 3, so let's just put this on the screen. So the first bet that Soros made was that the pound was going to fall because the exchange rate mechanism was going to break down. And basically the pound was going to fall and the Deutsche Mark was going to go up. Second thing is that they were going to see a dramatic decrease in European interest rates from surging bond prices. And the third thing was that they were going to see a rise in terms of the British stock market. So, and in terms of the last point is that so typically if the British pound was to fall, that signals that creates inflation by a lower exchange rate. Typically that means that bond prices will go up. Bond prices will fall because the yields on the bonds go up, but the share market will go up when you have an inflationary conditions. So Soros said, well, if this agreement between Britain and the UK was to collapse, these 3 things are going to happen. Pound falls, bonds fall, stock market goes up. And if I put bets in all those 3 markets, I'm going to make a lot of money. So as we get into the second half of 1992, as the Germans basically make these public comments about they're not interested in helping the British defend the pound, Soros had a position of about $1 billion in these 3 bets. And then on one morning, and I'm not sure exactly what the reason that led to this decision, but Soros decided to increase his bet from $1 billion to $10 billion. So he went out and borrowed $9 billion, and he just flooded the market in these 3 positions that the pound was about to collapse. Now, once the market realized that Soros had placed these positions, that created a lot of chatter, a lot of commotion among all the other financial powers inside London, and everyone else started to copy Soros. And all that pressure about the pound falling led to the pound collapsing. Now, throughout this tumultuous day, and so there's a number of documentaries which even the BBC have put together about this particular day.
Watch out, excuse me.
5 years ago today, the government faced one of the biggest financial crises in history.
It was incredible. You can hear wave after wave of selling hitting the market.
It was a day when the Bank of England lost billions and speculators made fortunes.
It was in excess of $1 billion of profits.
Who lost 15%?
A day of disaster from which the government never recovered.
It was quite clear the government was not in charge of events.
I had no doubt we were in the middle of quite the biggest political crisis that I could remember.
In the course of that day, as the pound is falling, basically the Bank of England officials are in regular communication with the Chancellor of the Exchequer and the Prime Minister, and they're basically saying, well, what do we do? John Major basically said, we can't collapse. Now, I should say, politically, John Major had made a very big deal about this exchange rate mechanism.
Yes.
It was the centerpiece of his economic policy. This was the road path to prosperity under his government. And it would be very embarrassing, both economically and politically, if he was to abandon this agreement. So when he was initially told, Soros has just increased this bet, the pound's falling through the floor, we need to abandon this exchange rate mechanism. The answer was, well, we can't do it because of politics, effectively. So what happened was, throughout the course of the day, in one day, so when we talk about interest rates on our show, Martin, what a lot of Australians would not know was that in this one day, John Major's government increased interest rates with the Bank of England 5% in one day. So went from about 10% all the way up to 15%. So there was one rise, I think, in the afternoon, and then later in the evening there was a second rise. But those two, and obviously, as you increase interest rates, that should attract foreign capital, and that foreign capital should be coming into your currency, and that should try to stabilize the currency. So that's the reason why they raised the interest rates. But as they raised the interest rates, that created more commotion in the markets, and it wasn't enough to calm the markets down. And all the speculators kept on betting that the pound was going to fall. So by late evening, the government was forced to abandon the exchange rate mechanism, and it was the most costly financial day in English history. I think from some of the accounts I've read, England has never or the United Kingdom has never recovered from the amount of money they lost that day. Now, what happened to the pound? It fell 25%. So like I said, when a price floor is removed, the price goes towards equilibrium. Well, what was equilibrium with the pound versus the Deutschmark? It was 25%. And because George Soros had bet $10 billion that this was going to happen, his profit for him and his clients was about $1.3 billion. And he made that in about 4 weeks. And even though some people think that some of what he's done with those proceeds is quite nefarious or evil, from an economic point of view, what he achieved using a basic microeconomic concept was actually pure genius. It was on the sort of perhaps scale of what Napoleon would have done on the battlefield, but that's what Soros did. He found a manipulated market, the foreign exchange market. He found a price floor above equilibrium. He found a way to break it, and when he broke it, the price of the pound went to equilibrium, and he made $1 billion in 4 weeks.
And John, I was there, of course, in the UK at the time, and I still remember the various announcements they made through the day as they put rates up and then had to put rates up again, and the air of panic, both within the political sphere and in the financial sphere, and the realization, which came late in the day, that the markets were going to win and there was nothing they could do. And that is very interesting because, of course, up till that point, both the government and indeed the Bank of England believed that they could control the markets, right? And basically the markets controlled them.
Yep, precisely. Now, how is this relevant to the silver market? Now, so again, it depends on your perspectives as to, is the price of silver today a fair market value price, or is it a distorted price? So people can go, so I've read a number of articles on my website, adamseconomics.com, or people can email me, John@adamseconomics, and people can read some of my analysis about why I think the silver market is distorted. We covered some of those factors in one of our shows last year that people can go back and look at. But I should say, now that silver is the talk of the month, there is a lot of chatter right across the internet with a lot of different people saying that this market is manipulated and the price is going to go sky high. So I'm not the original person of the silver market manipulation thesis. It is contested, but there's a lot of good evidence, and there's a lot of people across the world who say that it is a manipulated market. So it's ultimately up to our audience to make that judgment as to is the price you're seeing on the screen for silver, is that a fair market price or is that a distorted price? And I would argue it's unlike the British Soros situation, this is which was a price floor above equilibrium, we have a price ceiling below equilibrium. And what that means is, just going back to our previous graph, is we have demand more than supply. Now, when you have demand more, now I should say there's a number of techniques that the bullion dealers, refiners, and the banks have used to suppress the demand for real gold and silver. A lot of it is involving fraud, basically. So you may have we've discussed in a previous show about gold leasing. Now there's a concept called rehypothecation, which is basically taking the same ounce of gold or the same ounce of silver and promising that to multiple parties. So multiple parties believe that they own the same ounce of silver, but in effect that they don't. And the claims range from anywhere from there could be up to 500 claims per ounce, up to 1,000 claims per ounce. So that's how they try to stretch out this excess demand by making people believe they own something that they technically don't. And without getting into legal hot water, there are multiple products in Australia, and I've written this in an article without mentioning any firms who supply these products, but there are multiple firms and financial instruments in Australia which make people believe they own gold and silver, but they actually don't. And people don't realize that when they... So these are examples of pool allocated, unallocated, exchange rate, so in terms of ETFs, people put money in these products thinking they have exposure to gold and silver, but they technically do not have any legal title to a particular ounce of gold or silver. So these are some of the techniques that they try to mask of this in terms of this excess demand. But the question that I have looked at this so I know that from history, when you have stagflation, from a macroeconomic concept, you're going to get a rush of gold and silver, people rushing to gold and silver. But the question at a microeconomic level is, if we have a price ceiling below equilibrium, can all this demand? So the Wall Street bets, when they talk about the silver squeeze, the whole premise is that if everyone rushes into the market and demands physical silver, there'll be so much demand that it will break this manipulation, it will break this price ceiling, and what happens to the price? It goes towards equilibrium. Now the key question for those interested in the silver market is, well, what's equilibrium? So at the moment, today's price is about $27.50 US an ounce. People will be looking on YouTube and saying, silver's going to $100 an ounce, $200 an ounce, $500 an ounce. Some people saying up to 1,000 an ounce plus. So where are these numbers coming from? It's based on this premise that once this price ceiling is removed and the price moves towards equilibrium, the equilibrium price is multiple times higher than the current price. But in effect, because this market, in my view, is so distorted, no one really knows what the equilibrium price is. I know it's a lot higher than where we are today, but where would the price go in a free market? No one really knows, purely because we don't know how many real ounces there are versus all these paper promises that are distorting the market.
And I'll just add over the top of that, John, you've got the derivatives, which basically are traders who are taking positions in both gold and silver with no intention of taking it to delivery, but are essentially taking a position to take the opportunity to move the market or take movements in the market and then close them out beforehand. And the one-to-many relationship between the derivatives and the underlying is another factor which also indicates more manipulation, more, if you like, financial betting on the markets. And I think you can extend that beyond gold and silver as well. And if you look at interest rates or if you look at currencies, right, the relationship between the underlying and the total transaction exposures is a one-to-many relationship. And so I think that this manipulation that we're talking about in the context of silver is true also in many other contexts too.
That definitely I would agree with. Although there are a number of analysts across the world who would say that silver is perhaps the most manipulated market. So I agree. There's manipulation right across the sector, from interest rates, exchange rates, various commodity markets. But in my view and the view of other people, the most manipulated market is in terms of silver. So if people want to know why have I been looking at the silver market for about 4 years, and I've been involved in it from a professional sense, working for a bullion company as well as investing in silver as well, it's because of this basic idea that we have a price ceiling below equilibrium, and if the ceiling ever was to break, and breaking this is precisely what Wall Street bets and this silver squeeze is all about. This chatter for the last 4 weeks, and we're going to cover this some of this activity that's been happening in a future episode. But if that was to break, my view is we're going to see price go towards equilibrium. That's going to be a lot higher, and for those who are positioned appropriately, they're going to make an extraordinary sort of sum of money, in a very similar fashion what George Soros did in 1992. But obviously, this show is not financial advice. People need to do their own research. People need to understand the risks, and obviously, people need to try to understand, how this market works. Because it's taken me a couple of years to actually understand how the price is set with these future commodity markets, vis-a-vis the COMEX in New York. So they are highly technical, they're highly legal. The rules change when it goes bad for the banks. And obviously one of the big factors, when we talk about political considerations is who loses if this price ceiling was to break for silver. People who are on the other side of the equation, who are making money in the suppression. And that's basically, there are 8 bullion banks which have what they call concentrated short positions on the COMEX, and some have said, and again we don't know unless if it happens, but some have said that if the price of silver was to go sky high, the losses to those who have shorted the market, these 8 banks, would be so colossal that they would go bust. And we're talking about 8 of the biggest banks like HSBC, JP Morgan, Citibank, etc. And we know from the IMF that if one of these, what they call globally systemically important banks, GSIBs, if one of them goes bust, that's enough to bring the financial system down, just like with Lehman Brothers in 2008. So while there are some members of our audience who are who have a financial interest in the silver price going up, there is a real big consequence to the entire financial system if that was to happen, given that the potential losses to the banks could mean that their ongoing viability is brought into question.
And I would argue, John, that that's one reason why this may not happen the way that Soros was able to do it, because you'll have central banks and the worry about financial stability, which we saw back a decade plus ago around the global financial crisis. And I wouldn't be surprised to see further bailouts, further quantitative easing, further support for the financial system to stop that very event happening. The question is, can they do it? The UK couldn't do it, but could they do it this time? Nobody knows that, and that's why there's a level of uncertainty that we've never seen in our lifetime before.
Sure. Now, if people go onto my website, I just published an article yesterday talking about what's been happening in the silver market for the last 4 weeks. So we're getting, there's definitely more pressure being applied in this market, and I think the banks are under more pressure to keep this price under control. Whether they can in the coming months, we'll have to see. But I think the purpose of the show is to really just provide a very basic explanation of a very basic microeconomic concept that you learn in first year microeconomics. Show that Soros made $1 billion in 1992, so that's in 1992 dollars, not in 2021 dollars. But he made more than $1.3 billion by collapsing a price floor and breaking the Bank of England. And that same basic concept, I believe, can be applied into the silver market. And the question is, can this manipulation be broken? We will have to see. There's millions of people around the world who are now learning this story, and we've seen a pickup in both wholesale and retail demand in the last 4 weeks as more people buy physical silver. There's an attempt to engineer this, and we'll have to see. But I think that if people want to learn more about this whole story about Soros from the Silver Moonshot, go to my website, read the article. People can contact me, but there's definitely more to the story than what you read either in the financial press or just by most people buy gold and silver by just looking at a screen, but people don't actually understand where that price comes from, how the price is determined, is that price the real price, and what elements of the market have been put together to basically keep the price under control for so long. So I hope that provides a different point of view for the audience. I definitely have enjoyed this journey, learning about silver over the last few years because I just find this very fascinating. Just from just being me in terms of being an economist, there's definitely a lot of rich things to look at from an economic point of view, and so there's definitely more to this, and hopefully we get to talk more about it in the near future.
Yeah, and John, just to underscore, what we're talking about in the context of silver, I believe, is fundamentally true for many other financial markets too. And that's one of the reasons why the pools of derivatives around the world, the bond markets, the stock markets, the gold markets as well, they are all under a degree of manipulation. And that means that you can't trust the price because the price doesn't give you the full story.
Precisely.
John, I appreciate your time today, and I'll look forward to the next episode.
Thank you very much.
Martin North, John Adams, in the interest of the people. We'll see you next time.